Hello, everybody, and welcome to our halftime market note video presentation. This video audio presentation is designed as an accompaniment to the hard copy market note that will be distributed to all clients of the Integra team at Wealth Enhancement. So we're in the month of July, and we've been working on this for several weeks, as well as the market note. This is really just intended to share with all of our clients of the Integra team what we're reading, what we're thinking in terms of things that have impact on your investments. And so this was just designed to really sort of enhance some of the writings that we put into the market note. A little bit of data on Wealth Enhancement, aside from just our team, 164 offices nationwide, 600 plus financial advisors in the company now. Lots of awards and accolades from Barron's to Forbes. Our firm is obviously very well regarded within the industry. Currently sitting at, as a firm, not as a team, $117 billion in client assets under management and a 97% client retention rate that we're quite proud of. So today, as you'll see, as you read through the market note, our team selected 6 areas that we were going to focus on that have impact on your investments and therefore your money and your finances. So those 6 topics are overall market conditions, overall economic conditions, I should say. I'll be discussing that piece myself. Within the market note is a brief discussion on monetary policy and fiscal policy. I'm not going to focus on that in the audio video version of this, but it is in the market note. Alex Galt, who's with us as well today, will be covering equity markets. Tom Breiter, who's also with us, will be covering the fixed income markets piece of this. And then Andrew Gibson is going to address a particular financial planning topic, the Social Security decision. We tried to focus on things that we hear a lot about from you as we meet with you on a regular basis. So with that, some pictures and of our presenters today, but of course we are here in person in video presentation as well. So let's start out my piece here, the macroeconomic environment. Okay, so I'm going to give you kind of the punchline first, your key takeaway from what we wrote about on economic conditions, and then I'll kind of support that with some data. So this is the way we see economic conditions, and how do we see it this way? By reading a lot of different opinions from a lot of different market strategists and economists that we follow and have a lot of respect for, and get it more right than wrong, in addition to internal resources at Wealth Enhancement. So there's two sort of, we live in a probabilistic world in our industry, and so nothing is certain, right? So we see current conditions as really just a lack of clarity on the direction forward. There's a lot of divergence in opinions and views right now. And so the higher probability outcome, which we would assign a 70% probability to, is that the economy is definitely slowing, as you'll see in the data, but is probably not enough to tip us into a recession, right? And there's a lot of reasons for that tipping, not the least of which is just the normal business cycle, where we're always going to experience troughs and recoveries and peaks and repeat. That has not been repealed. The business cycle is still very real and still very much intact. Or the lower probability outcome, which would be an actual recession, when a recession is technically defined as 2 consecutive quarters of negative GDP growth. And as you'll see in a moment, we've already had 1 quarter of negative GDP growth, and that was in the first quarter. That was a contraction of negative 0.2% in the first quarter of this year. But again, we assign that a lower probability of maybe 30%, and that seems to be the consensus out there as well. There's a lot of different models that track this. So where are we in terms of GDP? What do the numbers look like? I kind of want to tee this discussion up by saying this first part of the discussion is a rear view mirror look at the economy. This is what's already happened, okay? So from a rear view mirror standpoint, as I said before, GDP growth contracted in the first quarter. So that's what's already happened. The second quarter, which we've already experienced, that first estimate, there's three different releases of GDP growth information. And the first estimate is due out July 30th. So we don't even have that number yet, even though that quarter has already occurred. So like I said, this is all rear view. It's already what's happened. Okay. And as you'll see in this chart here, the biggest component of US GDP or gross domestic product growth is consumer spending, which is us, right? And so that's where it becomes the employment picture becomes important. The sentiment picture, how people feel about spending money and engaging in financial transactions matters. All those things go into the behavior of the consumer. Okay. I think it's also important to, when we're looking at such short-term data points, to kind of stretch things out. And where are we in terms of a longer term year-over-year trend in GDP growth? And as you can see from this blue dotted line in the chart, we are still at a positive 2.1% long term, which is fairly normal for a developed economy like the United States versus an emerging, rapidly growing economy, as we find in some emerging markets, say India, used to be China, Brazil, places like that. Okay. Now, if we turn to what we'll say a more current real-time model, the Federal Reserve Bank and that think tank maintains and has developed a model called GDP Now. So what this means to us is that they're just using higher frequency data. There is data that's being fed into that model almost daily or weekly as it's released rather than at the end of a quarter. So it's a more up-to-date model, if you will. Interestingly, that model several weeks ago was forecasting second quarter 2025 GDP growth at 3.4%. We felt that was optimistic, and sure enough, the latest revision to that model, as this high frequency data has been fed into the model, is down to 2.3645%, as you can see on this chart here. And it was also interesting to note that the Philly Fed, which participates in this model, but runs their own forecast, is forecasting only 1.5% for second quarter GDP growth. So what all of this data has in common so far is this theme of a slowing economy. Is it enough to tip us into recession? That remains to be seen, and there's really a total lack of clarity on that at this point, right? But I think, again, the takeaway here is the high degree of uncertainty in the gyrations in the data and the differing views, okay? So we've taken a look at the rearview mirror, a more current look. Now let's look at indicators that are better at predicting the future, at least historically, and that we find in something called the LEI, or the Leading Economic Indicator or Index. And this is developed by an independent group, research group called the Conference Board. So in May, the LEI was unchanged, but then we saw a decline of 0.3% in June. And then for the first half of 2025, the LEI was down 2.8%, and it has been declining at a substantially faster rate of decline, which is negative 1.3%, versus the second half of 2024. So leading indicators are declining at a faster rate than they had been at the second half and during the second half of 2024. So again, all indications in the data indicate a slowing economy. Okay. As a matter of fact, the only bright spot in the LEI was the stock price rally that we've seen off of the sell-off that we had earlier this year that was induced by significant sudden tariff announcements. And so stock prices are a component of the LEI, because often people say the stock market is a leading indicator of the underlying economy and the direction of that. Not always, but that's generally what people tend to say. But we'll see if that's true this time around. So little bit further evidence. I wanted to get you even more current. So these were two different pieces that I read in the Wall Street Journal. This was July 20th. You're going to see these are back-to-back articles, July 20th, July 21st. So here's one that says the U.S. economy is regaining its swagger. And then if you read the byline, it says consumer spending again after spring's tariffs chill, but some expect growth to be slow. So, I mean, mixed messages, right? You fast forward one more day ahead, and we find in the Wall Street Journal, U.S. leading indicators, as we just talked about in the LEI, showing economic clouds gathering. While no recession has been yet forecast, economic growth is expected to slow substantially in 2025, the Conference Board says. So there's a lot of mixed views and mixed data out there. We need more data. And I think the Fed agrees with us. The Federal Reserve Bank has left interest rates unchanged as they wait for more data. So I feel like we're on pretty solid ground in terms of our view right now. So this is a very fluid situation. So hopefully that sets the backdrop from within what we're investing into, okay? The economy matters not as an indicator of where stock prices are going or not going, but that affects sales and profits and so on and so forth within the investments in the companies that we are making on your behalf. That's why we spend the time to look at this, not as an indication of where stock prices are going necessarily. So with that, I think that's a good segue into the next section, which is equity markets. And Alex Galt is going to take us through a discussion on that. So take it away there, Alex.
Thanks, Brad. Appreciate the overview. And I am honored to be able to discuss the bright spot in the economy today, which is the stock market. I think that is a bit of a conundrum, and a question we get very frequently is, about the price to earnings ratio. And as we all know, there are many ways to value stocks. Forward price to earnings ratio is my typical favorite, our favorite. Most investors favor this metric as well. As a refresher, P stands for the stock price, E is for the estimated future earnings. And so I think estimated is the most important thing to mention there, is that it is future, simply an estimate, right? It is not backward looking, it is forward looking. It is what a consensus analysts think the stock price is going to be in the future and what earnings are going to be. And I think the most frequent question we get is, how should investors think about high price to earnings ratios in the context of these companies are simply growing, very, very quickly, and they're keeping up with their earnings estimates? How do we think about that in the context of the stock market? And, the chart here we're looking at simply shows the outlook and historical PE ratios based on where we are today. As you can see, we're at right about 22 times forward earnings. And, it doesn't take a statistician to tell that there are a lot of data points on this chart here, and the future does not look very bright at 22 times earnings. But does that mean anything, right? The answer is we don't know yet, right? I mean, a lot of this is data driven. A lot of this is AI driven, frankly. I think that the market is pricing in a lot of future productivity, and what weight that will hold is yet to be determined. Brad, if you go to the next slide here, we can speak more to the Mag 7 and its effect on earnings growth. Going back to 2021, you can see here that 60% of earnings growth was driven by the Mag 7. And if we go to 2025, that is down to only 16%. S&P X Mag 7, I will note, while it is a smaller share, it is rising. It is more than 3x what it was in 2024, expected to be in 2026 around 13%. So it is catching up with the Mag 7, but notable, the Magnificent 7, while they are expensive, it is a very large share of earnings growth. And so that, I think, is the biggest takeaway is, the Mag 7's earnings growth is declining as an overall share. We'll just need to watch over time what that looks like. Another question here, we talk about in the market note, the frequency of sigma events. That's a fancy way of saying events that typically do not happen are popping up more frequently. My favorite example is, just a few weeks ago, we bombed Iran on Friday, and we hit all-time highs on Monday. And every investor was left shaking their head, how in the world is this possible? And it has us asking, are traditional risk models still working in the market environment today? And frankly, that's something that we talk a lot about during our investment committees and with clients. And I think there's a two-pronged answer there. First and foremost, yes, we want to own stocks, we want to own bonds. We also want to own that third stool of the alternatives and private market investments that may or may not be impacted as much with stock market valuations and the increasing correlation between stocks and bonds as bond prices have kind of increased and rates have also increased at the same time. And so, Brad, if you go to the next slide here, you can see the S&P 500 index at various inflection points. This is why we want to remain diversified. While it has felt fun since 2007 and 2008, we have went straight up with a couple, steep declines. Every bear market we've had has recovered fairly quickly. And, investors from the 2000s realized that, there were periods of times that we were flat for a very long time. If you look at March of 2000, we didn't break even until October of 2007. Same thing looking at, 2002, 2003. We didn't break even in that time period until 2012 and 2013. And that is why we want to remain diversified, even though it's fun and exciting to talk about AI all day long and just owning the Mag 7. We want to own other areas of the stock market to prepare for, potentially more volatile times, in the market. Brad, if you go to the next slide here. So just, on that note, what practical steps can investors take to stay disciplined during the unpredictable market swings? Another, very, timely question. Got a chart here. If you go to the next slide that I think speaks to that is, you got to stay the course. And we don't want to sound like a broken record by saying that, but you look back since 1990, look at all these notable events that we've had, and the market continues to be resilient. Now, it does not mean you can't make tactical, thoughtful changes to your portfolio, right? And reducing equity risk in some areas, making sure you're not too concentrated, making sure you own international stocks, which of course have been a bright spot this year, albeit a little bit less so in the past. Various market events throughout the year, and we have still risen by over 10.5% on an annualized basis since 1990. So, that is the overarching, point here with those Sigma events and with those, more common kind of uncommon events, I will say, they're just so dang unpredictable, and we'd recommend working with an investment advisor and really remaining diversified throughout this time.
All right. Hey, thanks, Alex. Appreciate that. Very insightful. We're now going to shift to another part of your portfolios, which is the fixed income and bond markets. And Tom Brighter is going to talk to us about that. So please, Tom.
Greetings to all of our clients out there. Thanks for listening in. Just a couple comments before we get into some of the data. I think we need to be careful of an emotional concept called anchoring. We've just went through a very long period that ended a few years ago of zero interest rate environment and 10-year treasury bonds down in the 1% to 2% range. People feel that interest rates are very high today. They want mortgage rates to come down. I would say we're actually at a pretty normal state for the fixed income markets right now. If we look at the last 100 years, the average rate on a 10-year treasury bond or yield on a 10-year treasury is somewhere between 4.5% and 5%. And today we find ourselves at 4.4% as of today. So pretty normal level of yield. Mortgage rates for the last 30 years on 30-year mortgages, somewhere between 6 to 7% average cost of borrowing money to buy a home. And today, that's right where we're at, around 6.5%. So for those wanting to see rates come down, I think we will see short-term rates come down when the Fed eases later this year, but that may not reduce longer-term interest rates or mortgage rates. So I think people need to, kind of adjust and not be anchored in the period from 2010 to 2021. That's my view on it. So fixed income generally can be viewed in two ways. There's the ballast of the portfolio view, which is where you own high quality fixed income, and usually high quality fixed income, so government bonds, high quality corporate bonds, tend to go up in price and down in yield when risk assets struggle. So the stock market struggles, usually you see bond prices go up, and that's why you own fixed income in a portfolio, because it smooths out the ride quite a bit. My personal view is that, and Brad points this out in the market note, if you don't think the economy's going into a recession, it can be worth taking a little bit of risk in fixed income, buying lower quality bonds, so high quality or high yielding, also known as junk bonds, floating rate bonds. There's very few 5-year rolling periods of time where taking risk in fixed income didn't pay off. However, those riskier fixed income investments can also suffer during stock market corrections. So you have to form a view of how you want to use fixed income. Is it ballast for the portfolio, or are you trying to enhance the return and still not take so much stock market risk? Those are my thoughts, Brad. I don't know if anyone has any questions on that.
That was great, Tom. That was really great. Very well said. Kind of deciding, what role fixed income, that piece of the portfolio is going to have for you, either ballast or if we believe no recession, and maybe just a slowing economy as I depicted, that makes a ton of sense. So appreciate that. All right. That brings us to Mr. Andrew Gibson, who is going to lead us through a short discussion on the Social Security decision, because this is a hotly debated and hotly asked for topic of analysis by you all. Andrew?
Yeah, thanks, Brad, and appreciate everybody listening to a very important topic, maybe a little bit boring though. But Social Security, I have the pleasure of working with almost every single client on our team. And one of the big questions we've been getting recently is, how do I take Social Security? Is there a right time for me? If I'm married, how do we go about doing that? What if I'm divorced? So these are kind of the questions that we're going to go through today. So when is the right time to claim? And it's really a personal decision, but also it's something that is personalized to you, right? So Brad, if you could just click the button real quick so some of my bullet points come up. So how do you decide the right time? Well, health and life expectancy, that's a really big one, right? Obviously, we don't know what's going to happen in the future, but you can lean on historical. How did your parents live? Did they have issues? Do you have issues right now? So that's one of the things that you would look at, because if you're in a position where you might be having some health issues, it might be a good time to look at taking Social Security a little bit early. Evaluating your income needs before benefits begin. So what does it cost for you to live in retirement? And one of those things is what type of sources of income are you getting? Are you getting Social Security? Some people are lucky enough to have some pensions. So things that are guaranteed sources of income that you're going to be provided, does that kind of float the boat for you in paying for your expenses, or do you need more? And if you need more, then taking Social Security now or soon, when you can, between 62 and 70 might be an option for you. Thinking about spousal benefits or survivor benefits, maybe your spouse has a reduced Social Security amount compared to yourself, and if you start taking your benefit, maybe they get a bump in their benefit. So that's something to think about as well. Again, it's really a personalized financial decision, and it's something that we try to not be emotional about, and we try to make sure that we're doing the math on it. So, how do you do it as a couple? What's the best way to claim as a couple? Well, high earners may benefit from delaying until age 70 because they're going to have the higher benefit amount. Lower earners might claim earlier to start getting some cash flow going in retirement. Also, considering age differences, if there's a 10, 20-year difference, obviously the person that's able to claim for Social Security might want to claim now or might want to wait until 70 because the survivor benefit will be increased for your spouse. So that's another thing to think about because delaying does help maximize survivor benefits. And then just coordinated strategy boosts your lifetime income. So it's a thoughtful discussion for couples to think about as you go to claim. And then a big question that we've had is divorce. Do you still qualify? And can you qualify for your ex-spouse's record? And the answer is yes, but there are some qualifying facts to that. You have to be married at least 10 years, 10 plus years. You have to be currently unmarried, and you have to be age 62 or higher to start receiving benefits on your spouse's record. So you can receive up to 50% of your ex-spouse's benefit at full retirement age, and ex-spouse's benefits are not affected at all. I know that's a question of, well, does that affect, the ex-spouse? Are they going to get notified or anything like that? They don't. And just remember, you earn the right to those benefits, so don't leave them on the table. Ex-spouses or ex does not need to be drawing for you to be able to be eligible for that. You just have to be above the age of 62, and you get the higher of your own or the spousal benefits. So if 50% of the ex-spouses is higher than your own benefit, then you can take on their benefit. And so again, it's really a thoughtful decision. It's very personalized, and it's something that you should be discussing with your advisor and also be discussing with your spouses as well.
Hey, thanks for that, Andrew. That was excellent. I think my takeaway on that, as always, is that, and you pointed this out in the beginning, this is a decision point that's just specific to each individual and each couple, and it's not quite as mathematical as some people think it is, right? So with that, we come to the conclusion of the little accompaniment presentation to the market note that you will all be receiving. I hope this was useful and helpful. It's a good way for us to disseminate information to a big and growing group of people, which is you, our clients, in a very succinct, very efficient way. There's obviously lots more we could have talked about, and we will continue those conversations during our one-on-one meetings with you as the year goes on. So with that, I hope everybody's having a good summer, and reach out to your whoever you're usually working with on our team if you have additional questions. Thank you very much for your time.